It's not just the $2.3 billion that allegedly simply vanished, it's how, and more importantly, why. Creating questions about collateral in this way does not end well. And especially since this does not appear to be a case of just some one-off theft and embezzlement, what happened was a company was pressured to the limit by an economy that is not living up to its expectations and creating conditions in finance as well as the overall economy that could lead to even more of the same. In one sense, it's a story as old as modern finance. The kind of late stage cycle behavior, the more we see of it, the more we know the cycle really is starting to get that late. In other words, what we're getting out of First Brands is that it might turn out to be more common than just simply a single company doing bad things. That's the thing about late stages. Where there's one, there are very likely to be a lot more. As one premier asset manager just said, we're starting to see more and more companies just hitting a wall. And another one from Morgan Stanley said, if this continues or things get a little bit worse, I'm scared it might shake some of the confidence. And then you might see some contagion. No kidding. We're already getting small whiffs of that in emerging markets credit. And everyone just assumed Jay Powell was right. The economy was strong and resilient. The labor market was solid. But First Brand shows maybe not so much. And then some negative payroll reports come up on top of everything. All of a sudden, there are indeed systemic questions that demand immediate answers. We are getting some from First Brand's bankruptcy. It is opening a small window into the shadowy world of factor financing and off-balance sheet arrangements. What it really shows us, though, is the interrelationship between regulated banks where the money comes from and these shadow banks which are redistributing the funds, and all of these different ways and opportunities for bad thinking and bad economics to come together, creating what the guy said, the potential for a whole lot more than just one bad apple and one bad actor in a gigantic sea of global credit. Now, specifically with First Brands, a creditor of the company, Raystone, which is a trade financing firm, last Wednesday it claimed that $2.3 billion in funds, quote, simply vanished. Now, Raystone is one of these factoring firms that have gotten to be so popular, and so these irregularities are raising a lot of uncomfortable questions about whether this really is just an isolated case, or if the industry and the banking sector has to start scrutinizing deals and assets as more of this loose cowboy behavior might be going on and popping up in a lot of other places. First Brands had said there was a $2.3 billion hole in its liquidity, which was related to factoring when it filed Chapter 11. Now, what's being alleged is that the company collected maybe $1.9 billion on the invoices improperly without letting the proper owners get the cash. Quote, after the Ohio-based company filed for bankruptcy, its attorney told Raystone in an October 2 email that they didn't know if the company had received the $1.9 billion. And following this, Raystone requested an independent investigator. Quote, first, do we know whether First Brands Group actually received $1.9 billion no matter what happened to it? Raystone's lawyer said, according to an exhibit that was attached to the court filing. And second, would you tell us how much is in the segregated accounts in respect of the factored receivables as of today? And as Reuters reported in response, First Brands lawyers said, number one, we don't know, which is already a very bad sign, and number two, $0. So this is nuts. I mean, where did all that money go? Why was there no governance on it? It sounds like First Brands collected on invoices it had already used and pledged as collateral. So already it raises more than a few governance issues that aren't specific to just First Brands. When collateralizing debts, the collateral itself is everything, because the firms that are providing the financing, they're undertaking a lot of risk otherwise. So anything that potentially undermines the security of the collateral for one company has the potential to trigger doubts about a lot more than just what First Brands has posted. Are other companies doing the same thing? Are they able to do the same thing? What kind of monitoring should we expect from all these factoring firms who maybe it looks like we're taking liberties or allowing companies to take liberties and not actually dotting all the I's and crossing all the T's in the way that they should have? Before we go on with our video today, let me ask you a question. What if your gold could actually pay you every single month in more gold? That's what today's video sponsor, Monetary Metals, lets you do. And here's how it works. You still own the gold, it's still in your name, it's fully insured, but instead of just sitting there doing nothing, it actually starts working for you. Monetary Metals has built a system that turns idle gold into productive gold, earning real yield paid in physical gold, not dollars. No selling, no trading, no converting. You keep your gold, and every month you get more of it. It's a simple idea, but it solves a big problem. If gold is money, it should act like money, and now it finally can. If you're a long-term gold holder looking for a smarter way to store value, check them out at monetary-metals.com/Snyder. Again, that's monetary-metals.com/Snyder. I highly recommend booking a call with them today to see if they're the right fit for you. We thank Monetary Metals for their sponsorship, but now let's get back to the rest of our video. Going back to Reuters again. Its collapse, meaning First Brand's collapse, has rattled debt investors and sparked concerns of broader stress in corporate debt markets, especially about rising risks in private credit, where lending activity has surged in recent years, and that is an understatement to put it at the least. Now, the first question you're immediately asking, where do these factor firms get all the money that they're lending to all of these private businesses? And these are the opaque connections between shadow banks, private credit, whatever you want to call these firms, and the regulated banking sector, usually through wholesale markets. Now, the banks themselves, they sponsor these factoring firms just like they do a lot of private credit funds and firms otherwise. In many cases, they outright own them. And even where they aren't owned or directly sponsored, banks are providing funding to these non-bank, shadow bank private credit firms through largely secured arrangements of their own in wholesale. Going back to Reuters again. Early in the day, this is last Wednesday, Jefferies revealed that Leucadia Asset Management has about $750 million in receivables linked to First Brands Group, and UBS likewise said it is evaluating the fallout, noting exposure of over $500 million to the parts maker. Now, Leucadia is the financial services holding company of Jefferies, and Leucadia Asset Management is another one of those companies and brands under the Leucadia umbrella. It's an investment bank in the old sense of the word, meaning it undertakes intermediation operations of all different kinds, which are colloquially known as financial services, and it leverages its connections to wholesale money markets and other regulated banks, which allow its various companies under its umbrella to create cheap funding arrangements for these intermediation activities. And then it seeks out riskier uses for all that cash that it can get more cheaply because it intends to pocket spreads on time and risk wherever possible. So it can borrow at, say, cheap repo rates in the marketplace or among its connections, and then relend the funds to factoring firms who then relend to companies like First Brands for a rate that's well above the original borrowed funds. So the regulated banks are taking on what seems to be manageable risk in straight up wholesale repo, and then allowing these factoring firms and private credit and shadow banks to take the full risk of relending the funds to the riskier borrowers like First Brands. But it isn't, like everything we see in the modern financial world, it isn't that simple. This is the kind of late-stage cycle problems the markets have been warning about, that maybe this is more of an issue than everyone has been thinking when they were just blindly accepting Jay Powell's strong economy narrative. And it is those market signals that we are going to be going over tomorrow, Tuesday, October 14th, 6 p.m. Eastern Time at Eurodollar University's webinar on the hidden truth, the hidden secrets, the hidden wealth of information in the marketplace. There's a link in the description to sign up. There's still time for you to do so. We are getting all of these signals from across the marketplace, not just telling us what has happened, but also looking forward. What are they telling us about First Brands and private credit, shadow banks, and a whole bunch more? You can't understand that information if you don't know where it's coming from and how to decode it. And let's face it, economics and central bankers have done a horrible job either giving you bad information, sometimes purposefully, a lot of times purposefully, or if when they're not trying to be intentionally disingenuous, they're giving you backwards information, especially where it comes to these vital fundamental signals. Well, we're going to start to change all that tomorrow, October 14th, 6 p.m. Eastern Time. Link in the description to sign up for a webinar. It will be well worth your time to attend. And another factoring firm that has come up in the First Brands bankruptcy is a company called Onset Financial. Now, this one specializes in lending for equipment, particularly heavy equipment, using those machines as the collateral for the loans that it makes. And like most of the other non-bank firms that are out there, It really is filling in a need in the marketplace that was left over after the 2008 crisis because Ben Bernanke and QE were total failures. Banks won't, and really they can't lend, thus depression economics that we keep talking about here. That's the signals across all the marketplace because money doesn't flow the way it actually needs to, especially to smaller and medium-sized businesses that are shut out in the depression economics of the silent depression era. Regulated banks like safe and liquid, but the economy needs everything else other than safe and liquid. It needs firms who are able to pry money from the banks and then redistribute it all over the system. That's what intermediation actually means. Taking money from where it sits idly, doing no good for anyone, especially if it's lent to the government in the form of a treasury bond. It takes that otherwise idle or poorly invested money in terms of the real economy, and it puts it to more productive use. As Onset itself says in an example that it raises on its website, unlike a typical bank, Onset can be more subjective in how we extend credit, and this gives our customers the option to lease assets that banks won't touch because they are illiquid, and banks and repo and wholesale market providers only want the safest and most liquid collateral. So Onset takes all the risk, and as Onset continues here, it has funded this particular supplier they're talking about with over $50 million in leased equipment ranging from Chinook and Black Hawk helicopters to a variety of fixed-wing commercial aircraft. Our financing gives them exceptional flexibility in how they employ the equipment that is leased through Onset because the banks otherwise won't give this business a second phone call. They won't return their calls. They won't even answer their inquiries because banks are all over safety and liquidity. So these shadow banks have stepped in trying to fill that need, and it is a legitimate need. But the questions here in the 2020s, especially with Jay Powell and his strong, resilient economy nonsense, is whether or not they've gone way too far and missed the point of no return, which is showing up as late-stage cycle behavior. When the assumptions about the overall economic climate bleed into those, as Onset said, subjective decisions to extend credit, it can turn out to be very wrong. Now, that's bad in its own right, but it's much worse when lending volumes that have exploded under all of these bad assumptions. That's bubbly behavior combined with the late-stage cycle processes, and it can become the seeds of much wider financial and macroeconomic trouble. And it might just need nothing more than a spark of bankruptcy to get all those private credit sources and all the regulated banks that are behind them, supporting them, sponsoring them, and even owning them to start asking questions that should have been asked all along. As Bloomberg wrote just last week, more highly indebted companies will tip into distress as the U.S. economy slows and earnings suffer, according to Aegon Asset Management. Quote, "I am bracing for a little bit more trouble ahead," said Jim Schaefer, the $380 billion manager's global head of leveraged finance. That's what he said in the latest Bloomberg Intelligence Credit Edge podcast. "We're starting to see more and more companies just hitting a wall." Schaefer continued, "I'm more concerned about restructuring activity, recessionary market conditions than I was 12 months ago. We know the economy is slowing. We know we're going to start to see the top lines waver a little bit. I worry about private credit because we don't exactly know all the underlying default risk in there. And anytime you see money move in scale and excess in any area, it usually is going to create some problems. And that is an understatement. And of course, none of that matters when everyone agrees the economy is strong and the labor market is rock solid. You don't have to think about risks of borrowers defaulting. And even if you did, there's also rock solid collateral that's backed by confident lenders, confident there's nothing deeply wrong in economy or finance. It all keeps going, churning out new loans on increasingly generous terms. We all know the bubble processes. And as Steve and I talked about yesterday, that's what's so potentially devastating about negative payrolls. Yes, it's bad when people lose their jobs, but it's also the one signal that says, hey, hold up here, something isn't right with the real economy. Therefore, all of those assumptions that went into the credit bubble to begin with, it goes straight to the heart of all of these cyclical assumptions. And then if you throw some collateral irregularities on top of it, that's when it gets to be really uncomfortable, especially if when taking those second looks, those doing the looking find out everything from lending decisions to collateral governance really did get to be far too loose and far too cowboy. And these tough questions don't just apply to U.S. businesses in the domestic credit market. Like 2016 to 2017, there's been an ongoing EM credit bubble of sorts too, and we're reminded of that bubble and its downside last month by Argentina's reacquaintance with the angry Eurodollar. Now, an angry Eurodollar is really just everything that I described here, the banking sector going in reverse. Banks pull back their balance sheets, which means there's less money getting circulated around funding markets in response to greater concerns over economic conditions that govern credit losses, and more importantly, credit loss perceptions and models. When banks and dealers pull back, the consequences flow into every corner and region. Now, offshore, it's why the dollar goes up in exchange value, meaning those around the world borrowing dollars from Eurodollar suppliers have to pay more to do it. That's the connection between the dollar exchange rate and tighter financing conditions. It's not the higher dollar that creates the problems. The, quote, stronger dollar exchange value reflects the increasingly difficult monetary circulation that goes back to concerns about rising loan problems linked to a bad economy that was never really good to begin with. But as long as banks and shadow banks thought everything was just fine, the banks provided the funds that shadow banks then relent to increasingly riskier borrowers outside as well as inside the US. You take away the assumption of the solid economy, suddenly banks and shadow banks are taking second looks at all those EM borrowings as well. So we'll go back to Bloomberg one more time. Corporate bond routes from Sao Paulo to Istanbul are signaling to investors that the standout run in emerging markets may be starting to show some cracks. Funny how these cracks show up as the economy itself displays major cracks. In Brazil, trouble at a chemical giant Braskem has money managers bracing for a potential debt restructuring, and waste management firm Ambipar, I'm not going to pronounce that, is on the verge of filing for bankruptcy. Over in Turkey, a government probe into industrial conglomerate Sinor Group sent bonds of subsidiary WeSoda plunging. The blow-up risks derailing what's been almost 2 years of outperformance, which is another word for bubble, for company debt from the developing world against their global peers. As the cases pile up, the rally has started petering out over the last couple of weeks, at least according to a Bloomberg index. These are surprising events that are deeply problematic, which is according to the head of emerging market corporate debt at Morgan Stanley's asset management arm. If this continues or things get a little bit worse, I'm scared it might shake some of the confidence, and then you might really see some contagion. And this is why there's been so much downside hedging, not to mention what happened on Friday. And we'll see how much that might spill over tomorrow once banks and bank dealers get back from their holiday weekend. Now, everybody understands at the very least, this isn't some small triviality. Even those who may not be fully persuaded that there's a serious global downturn coming can at least appreciate the possibility and what that will likely mean, and which is why they've likely taken out some hedges against the rising risks of that might be happening. So just look at the government bond holdings among regulated banks from all over the world, whether it be the United States, Europe, or even China. While the mainstream media was running around shouting how Sell America was rejecting treasuries this summer, banks were busy buying tons of them. And it wasn't due to some perceived patriotic duty to support the market for U.S. government debt. It's depression economics, demand for safety and liquidity. And since early April, U.S. banks have piled into another $122 billion in treasuries and agencies. At the same time, they're still lending to these non-banks. Why? It seems like the regulated banking sector is buying all of these treasuries and agencies, these safe and liquid instruments, as a hedge against the possibility the shadow bank exposures might be going wrong, and thinking that just owning safety and liquidity in treasuries will be enough of a hedge against what would be, what everyone hopes will be, just manageable downside risks. And that's where the First Brands bankruptcy might end up spoiling this thinking. If the problems are shown to be more widespread, these weird problems that we keep getting, especially anything related to collateral, that means exposures grow to be a lot more than anticipated, and that potentially cuts off even more funding for the shadow banks, which cuts off even more funding for all of these struggling firms, and on it goes. As the Aegon guy said, then those firms really start to hit the wall. And as the Morgan Stanley guy said, then we might really start to see some contagion. Interest rates that go down by a lot, and stay there for a very long time. Late stage behavior along with bubble financing and credit, certainly one way for that to happen. It is not an accident why cars and the car business are at the forefront of all of these things, whether macroeconomic or financial. Went over what's happening in Germany, the plunge in cars in Germany, in the video link below. As always, thank you very much for joining me. Join me tomorrow for our webinar, link in the description to sign up. Huge thanks to Eurodollar University members and subscribers, and until next time, take care.